For those of you that don't know me or that haven't jumped on here yet, I'm Daniel Halverson. I run Halverson team with Loan People. And we do this every Friday at 10. I think we've maybe missed 1 or 2 weeks since the start of the year. So we're pretty much here every Friday. If you ever miss it, we do send out the slides. We send out the recording via email. If there's a topic that gets of interest to you and you just can't make it, we do send that information out. But the general gist of it is it's very quick, just a 10, 15-minute update touching on interest rates, some type of loan guidelines that may be helpful, and then picking a topic to maybe dive a little bit deeper into, just to give you a little context. So really for most of this month, focus a lot of time on appraisals and appraisal waivers and reconsideration of value. And we'll talk about some upcoming appraisal changes as far as the actual appraisal forms that are supposed to happen later this year. So that'll be the general gist of what we'll talk about here for the rest of the month. But like I said, short and sweet, probably won't take more than 10, 15 minutes. If you have questions as we go through it, feel free to stop me at any time. And if there's any questions at the end or any just general questions, completely unrelated to this is the time that I've set aside to be able to answer them. As usual, really like to start things off here with talking about what interest rates are doing and doing it on a weekly basis. So from last week to this week, you can see rates are pretty much exactly flat. So no real change in interest rates this week. But if you zoom in on the chart there, you can see a lot of volatility up and down here this week. So it's been an interesting week. But really the takeaway, same thing I've been saying the last really 3-4 weeks now, is the markets are trading on headlines right now with what's going on with the war. So really even a lot of the economic data has taken a backseat to what's going on with this war. And one day it gets worse and rates go up, and one day maybe it's going to reach a resolution and rates go down. So that's pretty much exactly what happened between Monday and Wednesday of this week. You see this sharp drop here. But really what I would say with that is obviously we can't control what rates are doing, especially not in volatile times like this. So I think that it's probably just more important if you have customers that are pre-approved, that are actively looking for homes, maybe just stay a little bit closer in communication with their mortgage lender, just to kind of understand what's going on and make sure that they know kind of where rates are as they make offers. And then even more important than that, don't time the market as a buyer. If you find a home you like, put an offer in, you have an executed contract, just go ahead and lock in the interest rate. A lot of companies, ourselves included, offer a float down where if they lock a rate, protect it on the upside. If rates come down, they can float that rate down. So there's really no reason to try to time the market. 9 times out of 10, either rates are going to be about the same or go up in that time frame, it seems. The right move is always to lock the rate. And then a quick did you know here, just picking a guideline that comes up every week, making a note of it and just making mention of it. But a lot of people don't know this. If a borrower has a debt on their credit report that somebody else pays for, and we can document that over a 12-month period, pretty much in most cases with most loan types, we don't have to count that payment into their debt to income ratio. Whether that's non-mortgage debt or mortgage debt, if we can show that somebody else is paying for it, we can exclude it from the debt to income ratio. And one distinction with non-mortgage debt, in some cases, the person paying it doesn't actually have to be on the loan. Important to note that if you've got a car payment, let's say, and the person that's paying it is a child or a family member, they don't even necessarily have to be on the loan itself to exclude that. Whereas if it is a mortgage debt specifically, the person who's making the payment has to be obligated on the loan. And you have to be able to document that over 12 months. So it hasn't been 12 months that the debt has been paid by somebody else, or if it was taken out less than 12 months ago, generally you can't exclude it. But just something to keep in mind if you're talking with customers and they mention that they've got a debt in their name and they're worried about how that could impact their ability to qualify. They mention that it's paid by somebody else, just know more than likely we wouldn't have to count that into the debt to income ratio. And Halverson team to the rescue here. Not all heroes wear capes, but we do. Wanted to share a quick story here from this week. I got a text from an agent on Monday asking about bridge loans. Had a customer that wanted to buy before they sold. And of course I said, yes, that's something we can do. I came in good timing with the training that I did last week and this week. But basically these folks, interesting scenario, they actually had 2 homes to sell. And the wife actually recently left her job. So you kind of line those things up and you might be thinking probably unlikely that there's a solution here. But we were able to find one using some of their retirement assets and looking at a couple other creative ways to do things. We were actually able to figure out a way where they could buy the new home without having to sell either one of those homes. And they're ultimately going to recast the mortgage balance way down after they sell both of them. But obviously, takeaway here, if you have a situation where somebody wants to buy before they sell, even if they don't think it's possible, I would suggest they talk to somebody, hopefully us, but talk to somebody just to see what's out there. There are a lot of creative things that can be done. There are a lot of creative programs out there for situations where people want to buy before they sell. So it's a question we're getting pretty regularly. I'm getting this question more than I think I ever have in my career. If somebody wants to buy before they sell, get them to us if they're open to speaking to us, and let's see if we can find a solution. And then the meat, potatoes, nuts and bolts of what I wanted to talk about this week. I mentioned this briefly last week, but wanted to just bring it up again and talk about appraisal waivers. So just so you guys know, there are situations where essentially we can get a waiver where we don't have to do an appraisal at all. And all that means is essentially it's conventional loans only, but we run it through an automated underwriting system. If the automated underwriting system tells us the loan is eligible for an appraisal waiver, then we don't have to do one at all. So, and that, once again, that's just conventional loans. So that is just Fannie Mae, Freddie Mac insured conventional loans. Other loan types, you're not going to be able to get an appraisal waiver. And the big thing that I want to mention here is, fortunately, there's no guaranteed formula where if somebody has a credit score of X or they're putting down a certain amount of money that you're guaranteed to get an appraisal waiver. So sometimes you could get an appraisal waiver at 20% down. And then for another customer at another property, maybe they're putting 50% down and you don't get an appraisal waiver. So there's really no guaranteed formula. And the automated underwriting system doesn't tell us as a lender, hey, if they put this much down, then you'll get an appraisal waiver. So it's really very much a trial and error. The lender has to run it through the automated underwriting system. But the other component of this that I think is super interesting is I sat on a call probably about a year ago, and it was with an appraisal management company, but they mentioned that Fannie Mae basically told them that they believe that they have property information on every single home in the United States of America, which I thought was fascinating. But basically what happens in that automated underwriting system is they're taking borrower's qualifications, credit score, down payment, debt to income ratio, and they're also looking at the property address and saying, hey, based on all of the data that we have, we think this home is worth somewhere between here and here. And if you're somewhere in there and it likes the borrower profile, then that's what triggers the appraisal waiver. So if you got somebody that's put a good bit of money down, pretty easy for a lender to run it through to get an appraisal waiver. So that's something you could do before you make an offer, in the event that you could potentially come to the table stating that maybe you don't need an appraisal, or obviously, if nothing else, it saves the borrower money. It saves time on the loan. You don't lose the week of waiting for an appraisal to come back. And then lastly, it obviously cuts away the variable of what will the home appraise for. Just something to keep in mind if you have a customer you know is putting a lot of money down. Might be a good thing to ask the lender, hey, did we get an appraisal waiver, just so you can see if that would be an option. Quick little save the date here. I mentioned we're spending the most of the month here talking about appraisals specifically, but I'm actually doing this training at the Southside office on Wednesday, May 27th. I'm going to have Chris Henderson from the Henderson Appraisal Group come in and do just a general Q&A. So it'll be primarily open forum for anybody to ask questions appraisal related. If you want to know the logic behind it or how they might view something, or information that you can provide as an agent to maybe help them from an appraisal standpoint. It's going to be just a very general Q&A. There'll be a brief open forum where I'll ask a few pointed questions, but then I'll really open it up to you guys to ask any questions that you want. So you could try something a little different. Instead of listening to me talk, you can listen to somebody smarter than me talk. So if you can make it Wednesday, May 27th, Southside office, we'll also do it on Zoom. So if you can't make it, there'll be a Zoom option as well. And last thing here, wanted to spend some time talking about reconsiderations of value. Just curious, is anybody, you can throw it in the chat or say it out loud, is anybody ever trying to do a reconsideration of value on an appraisal?
No.
No, but I have a buddy that wants to protest his property taxes, that falls into this category.
That's a little different. Yeah, a little different. We can actually talk about that at the end here, but completely separate process from a lender appraisal. That's not something that gets communicated to the county as far as the value from a tax perspective. But essentially, what a reconsideration of value is, that's a formal process that's used primarily through the borrower, or with the borrower through the lender rather, to challenge the appraisal and ask for the appraiser to reconsider information to hopefully reconsider the value, the appraised value of the property. And the ROV, reconsideration of value, it challenges an appraisal based on factual errors or use of other comparable sales. So that's what it is. And to kind of go a little bit more in the weeds with that, as far as when one might be warranted, the big thing I would say here is a reconsideration of value is not necessarily warranted just because the appraisal came in below the sales price, right? We don't ever do reconsiderations of value when it appraises for too much. It's always when it doesn't appraise for enough, right? But what we're looking at specifically is we have to have material evidence that there is inaccuracies or deficiencies within the appraisal to request a reconsideration of value. So you can't just say, hey, we don't like the value. Can you go find another comp and try to boost the value up? So it's our job as the lender to provide information to the appraiser of errors or omissions, things that are not done properly in the appraisal, maybe information that you feel is important to be included that wasn't included, primarily spending time on maybe providing additional comparable sales. So saying, hey, there's one or two or three other sales here that we feel are more indicative of property value. And then we can also provide information about if market conditions have changed from the time the appraisal was done to now. And generally speaking, I say we, the lender, we're the ones that submit the request, but the borrower generally doesn't know enough about sales and appraisals to provide this information, right? So we're normally heavily leaning on you guys as real estate agents to help us say, hey, we think that this sale is better than this one, or the appraiser notated this, which we feel is inaccurate for the following reasons. So a lot of times it's a group effort between borrower, you all as real estate agents, and then us as a lender. We are really more so the middleman to make sure that information gets passed along to the appraiser. And just a quick step-by-step. So you get an appraisal in, maybe it's not what you were hoping for. Next step, borrower wants to do a reconsideration of value. Step one is to gather up the things we just talked about, supporting evidence and documentation. Step two is there's a request or a reconsideration of value request form that has to be completed. And in some cases, it actually has to be signed by the borrower before this can be done. And then that gets submitted to generally either the underwriter or whomever within that lender would be reviewing appraisals. So a lot of times it's the underwriter, sometimes it's like an appraisal desk. But they're going to look at that and say, hey, we're going to look at the form. We're going to try to evaluate what's a legitimate thing that we can include in this request. And if there's information that's in that request that's not relevant or doesn't help the cause, then maybe we massage the wording a little bit. And then once that's done, it gets submitted to the appraiser. The appraiser has some time to respond. Usually within a day or so, the appraiser is going to respond, and they're either going to give you a thorough explanation as to why the information provided didn't change the value, or they would potentially change the value based on the information that's provided. So that's a step-by-step of how that would work.
Would they potentially have to go back out?
No, they generally wouldn't. There's maybe one scenario where they would have to go back out, which I'll actually bring up here in a second. But generally, no, they wouldn't have to go back out to the property for the reconsideration of value.
Okay.
But just to piggyback on something I said a minute ago, so for conventional loans, those guidelines have changed where the borrower actually has to initiate the reconsideration of value. So we can't request it without the borrower's signature on the form. So it's very much supposed to be initiated by the borrower. And then with FHA loans, the borrower doesn't necessarily have to initiate the reconsideration of value request. So we could do it on their behalf. There's nothing that they have to sign for us. And then VA loans, they follow a different procedure entirely. And I'll talk briefly about that here in a second, because I think in my opinion, it's actually a little bit more favorable than the way that it's done on pretty much every other loan. So with VA loans, there's something called a Tidewater notice. And basically the Tidewater notice is something that the appraiser issues before they turn in the appraisal. And they have to notify the lender. And the purpose of Tidewater is basically to say, hey, if I were to turn this appraisal in right now, the appraised value is not going to support the sales price. So they basically give you a heads up, right? And then we as a lender go notify the borrower, the agents involved, and we have 48 hours to give them information that would be supportive of the contract sales price. Once again, same information we'd provide on a reconsideration. Are there other columns? Is there pertinent information? Was the home next door that sold for less a fire sale? So any information that's relevant for the appraiser, we provide that to them. And then they submit the report. So if they submit the report and they say, hey, thanks for the information, but it didn't change my opinion of the value, that's not the end all be all. you can still do a reconsideration of value after that original appraiser has turned it in. But the difference is when we submit that request, it actually goes to the VA Loan Center, and a staff appraiser that works for the VA reviews it and decides if the value should change or if it's acceptable as is. So VA loans, in my opinion, are actually a little bit more favorable because one, you get a heads up and you have an opportunity to address it with the original appraiser. And then if that doesn't work, then you get to go give that information to another appraiser. So you really get two sets of eyes on it as far as potentially being able to have a successful outcome with a reconsideration of value. So a little bit different than the other types of loans, but just wanted to mention that as well. And then the last couple things here. So an ROV is not a guaranteed fix. That's primarily what I wanted to point out here. But we can't just submit one because we don't like the value that we got. We have to be able to show material deficiencies, omissions, errors. Have to be able to rely on there's an issue with the appraisal that was done as part of primarily part of what we're trying to do with the reconsideration of value. And even though some of them are not borrower initiated, I think it's important that we always get the borrower involved before we submit a reconsideration of value, because ultimately they have the choice of if they want to submit a reconsideration of value or not. So we take it upon ourselves to do that without their knowledge. Sometimes that can turn sticky. So just a quick mention, we would always consult the borrowers along with everybody else before we actually submitted a reconsideration of value. And then lastly, if the appraiser won't budge, in some very rare instances, the lender has the ability to order a second appraisal. So I wouldn't necessarily count on that. Some lenders are very firm in that there's no circumstances that they would order a second appraisal, but it's possible if you can once again show material deficiencies. There is an option. I've done it in my career more than a time or two where we've ordered a second appraisal, which at that point you can either support that the original appraiser was right, or maybe you get a different outcome, right? So you can potentially order a second appraisal. And then Gina, actually back to your original question that you asked, it's something I wanted to touch on, something that happens from time to time. Let's say that a home is pending sale, but it hasn't closed yet. And the appraiser goes out on Monday, May 11th, and they return the appraisal on Wednesday, May 13th, and the value comes in $10,000 short. But on Friday, that pending property sells, and that becomes a really good comp because now it supports the price that these buyers that are under contract that have the short appraisal, what they're paying. Basically, the effective date on the appraisal is the day the appraiser lays eyes on the property. So in this case, that would be Monday. That's your effective date of the appraisal. So the appraiser cannot consider that sale that happened on Friday because it is after the effective date of the appraisal. So if you have a situation where you know there's a pending sale, obviously you probably don't know exactly what it's going to close for, but you feel like it's something that would help and you know it's closing soon. Something to keep in mind as far as maybe when we would order the appraisal, because at that point, the appraiser potentially could go back to the property and actually see the property again, changing the effective date, but not all lenders are going to let them do that. So important to note, if a sale closes after the effective date of the appraisal, that just becomes sticky. So if you ever have a scenario where you feel like a comp is going to close soon, that's going to help you, you might want to delay the appraisal until that has closed, if possible, obviously.
Okay.
But any questions about any of that?
I have one, and it might be more appropriate for the 27th. But what I've noticed so far, thankfully, I haven't had to think about, or we need another appraisal. But I've noticed that the appraisals either come back a few $1,000s more, and I just mean a couple $1,000s more than the sales price, or it comes back exactly at the sales price.
Yep.
Was there a rhyme or reason to that? Or am I just that good at my pricing?
That's definitely the second one. I'll give you two answers to that. The first one is, so you guys don't know this, but appraisers are scored by Fannie Mae and Freddie Mac. So when an appraisal comes in, there's a scale from 1 to 5. 1 being a low risk appraisal, 5 being a high risk appraisal, meaning that maybe they're pushing the value. So the appraisal gets scored. If the score is really high, we might have to order a secondary review of the appraisal, such as they call them collateral desk analysis, which is basically a desktop review. Sometimes another appraiser on our panel might have to look at an appraisal. That's called a field review. But the appraiser gets scored by Fannie Mae and Freddie Mac as well. So if they have a history of high collateral risk scores on their appraisals, then that's not a good thing for them as they try to get onto more panels and get in with more lenders, right? So if an appraiser doesn't have to push the value much, if the home is under contract for $500,000 and they can appraise it for $500,000, they're likely going to do that. Even if they could maybe push it to $550,000, why do that if it's going to increase the risk score to them? So that's the first thing. And the second thing I would say is, in my opinion, and with most of the appraisers that I work with, or we work with rather, the best indicator of what a home is worth is what a buyer is willing to pay and what a seller is willing to sell for. So as an appraiser, the buyer and the seller are telling you what the market is. Your job as the appraiser to find supporting evidence to support that or data that would refute that, right? So if a buyer and a seller are willing to transact at $500,000, chances are the value of the property is probably about $500,000 because we can show that's what someone's willing to pay and that's what someone's willing to sell for. So those would be the two best answers I could give you for why that appraisal is going to come in at 501.
Okay, got it.
So that was a little bit of a nerd answer, but that's a question we get a lot. Hey, why did the appraisal come in right at the sales price?
Well, thanks.
And then Jared, to answer your question, if somebody wants to contest the value of their property with the property appraiser, they can contact the property appraiser directly to do that. And I have not done this, but there's probably some type of procedure, information they can provide to support that they think their home is presumably worth less, so they lower their taxes. But a lender's appraisal is never, if we do as a purchase loan or a refinance, our appraisal is never communicated to the property appraiser. They have their own appraisers that independently determine what they think a home is worth.
Yeah.
So they can contest it. I think there's a company that Blue Ocean Title works with that's called My Exemption Check. And that's pretty much what they do. They contest property values for tax purposes. So your customer that wants to do that, they may want to work with a company such as My Exemption Check, somebody that specifically deals with that and has a lot of experience. They may be able to kind of walk them through that. Sure, there's some type of fee that they charge for that, but if we're talking about saving a few $1,000s forever on your property taxes, it's probably worth it.
Appreciate that.
Yeah, absolutely. Anybody else got
question for you?
Cool.
Does the same general framework apply for land purchases with appraisals and or disputing an appraisal?
Yeah, I would presume you probably have the same ability to do that. They're not necessarily agency loans at that point, as far as a land loan is not a conventional Fannie Mae, Freddie Mac backed loan. It's generally a portfolio loan that's done by the specific lender that's doing them. But they probably have a similar procedure where you could say, hey, there's other land sale comps that they didn't use, or maybe they said something about the land where this portion of it is not usable when in fact it is. Obviously land probably you would have different points of contention, but I would presume there's probably some mechanism where you could still do the same thing.
Got it. Okay.
Cool. If you got anything else, let me know. If you don't, we'll send these slides out, and appreciate everybody jumping on here.